Hi there, I'm Edward Khalstian, founder of EKH Capital, where we look for market-beating stocks for the long run. Today, we're breaking down Richemont, the Swiss luxury group behind Cartier, Jaeger-LeCoultre and other storied names in watches and jewelry. Known for timeless craftsmanship and exclusivity, Richemont holds a powerful position in the high-end luxury space. But how does the stock stack up today based on the fundamentals? We're going to break down Richemont stock using our 5 key factors to determine whether it's undervalued, fairly valued or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's jump in. First up, let's look if Richemont is turning investments into real value. Richemont's return on invested capital sits at 17%, with return on equity at 12.9%. Both solid numbers, especially for a company operating in high-end discretionary goods. That shows Richemont is efficiently deploying capital and maintaining pricing power, even amid market headwinds. Management continues to prioritize exclusivity and long-term brand equity over short-term volume. Their shift toward direct-to-consumer retail and reduced wholesale exposure reflects that. Moves aimed at strengthening margins and protecting brand control. While these strategies may take time to fully translate into financial performance, they show Richemont is focused on building long-term resilience. What about growth? Over the past decade, revenue grew at a compounded annual growth rate of 8.3%. Whilst this is solid, the story changes when we look at the bottom line. Net income grew at a CAGR of 2.6%. and earnings per share grew at a CAGR of 2.1%, reaching 4.7 Swiss francs in 2024. This tells us that while Richemont has been effective at growing sales, it has struggled to translate that into meaningful profit growth. Margin pressures, slower operating leverage, and elevated costs appear to be holding back earnings. Recent performance reflects this as well. Luxury demand has softened in key markets like the US and China. And analysts now expect mid-single-digit revenue growth through 2027, with little acceleration expected on the earnings side. That disconnect between revenue and profit growth raises a red flag. While Richemont still benefits from brand strength, high gross margins and a loyal customer base, it may need to do more to drive operational efficiency and protect its bottom line. Is Richemont on solid financial ground? As of 2024, Richemont holds around 16.8 billion Swiss francs in cash and short-term investments and 13.1 billion in total debt, giving it a very strong liquidity position. Its debt-to-equity ratio is just 0.6, which is healthy in the luxury sector. That shows Richemont has a rock-solid balance sheet and disciplined capital structure. The company has also demonstrated healthy free cash flow generation, allowing it to invest in strategic growth, including digital and direct-to-consumer channels, while maintaining financial flexibility. Is Richemont overvalued or a bargain? Richemont currently trades at a price-to-earnings ratio of 25, slightly above some luxury peers like LVMH at 17.9 and Kering at 19.9, but way below the valuation of Hermès at 51.8. On a relative basis, this valuation seems too high, especially given the lower earnings growth compared to its peers. Now let's look at the PEG ratio, which compares the price to earnings to expected earnings growth. Richemont's PEG is around 11.9, signaling the stock is strongly overvalued. Does Richemont have a durable moat? Richemont's moat lies in the power of its heritage brands, particularly Cartier, one of the world's most valuable names in jewelry. Add in Van Cleef Arpels, IWC, Jaeger-LeCoultre, and you get a portfolio rooted in centuries of craftsmanship, prestige, and brand recognition that few competitors can match. The company also benefits from strong vertical integration and control over boutique experiences. However, Richemont has been slower to adapt digitally than some peers. And the luxury landscape is evolving fast. Staying ahead will require continued investment in digital, sustainability, and relevance with younger luxury consumers. Before we wrap up, You might have noticed the clean, detailed charts in this video. They're powered by Fiscal. If you want to upgrade your investment research, check out the link in the description for a 15% discount on Fiscal's premium tools. In my view, Richemont stock is overvalued based on our 5 key factors. Richemont has solid returns on invested capital and return on equity. Revenue has grown steadily, but profits and earnings per share have lagged behind. Richemont has a strong balance sheet with 16.8 billion Swiss francs in cash and low leverage with a debt-to-equity ratio of 0.6. A price-to-earnings ratio of 25 and PEG ratio of almost 12 suggests the stock is richly priced relative to its earnings potential. Richemont owns elite heritage brands like Cartier, but it faces rising pressure to modernize and stay relevant in a digital-first luxury landscape. What's your take on Richemont? Drop a comment, hit like and subscribe, and let me know which stock you'd like me to cover next. Thanks for watching, and I'll see you in the next one.